Charlie Munger, How to Build Your First $1 Million Portfolio, the Easy Way. In the pantheon of financial milestones, the accumulation of the first $1 million stands as the psychological Rubicon. To the uninitiated, it represents a summit that can only be reached through extraordinary genius, speculative luck, or a lifetime of crushing labor. However, Charlie Munger, the late vice chairman of Berkshire Hathaway and the architect of the modern mental model of investing, viewed the first million not as a miracle, but as a mathematical inevitability for the rational mind. Munger famously derided the get-rich-quick schemes of Wall Street, preferring what he called the easy way. But do not mistake easy for fast or lazy. By easy, Munger meant a path free of complexity, free of frictional costs, and free of the catastrophic risks that destroy the average investor. The Munger path to the first million is rooted in the physics of compound interest and the psychology of discipline. It does not require you to predict the next Tesla or trade options on zero-day expiration contracts. It requires the ruthlessly efficient application of four specific principles: the conquest of the critical mass, the elimination of interruption, the selection of inevitable businesses, and the inversion of ruin. Munger argued that wealth is largely a function of temperament, not IQ. If you can suppress the urge to be brilliant and settle for being consistently not stupid, the laws of economics will carry you to the $1 million mark with the certainty of gravity. This video is not a collection of hot stock tips. It is a forensic analysis of the Munger blueprint for capital accumulation. We will deconstruct the mathematics of the bitch phase, analyze the tax-deferred geometry of doing nothing, and audit the portfolio architecture that turns a modest income into a fortress of wealth. This is the masterclass you cannot afford to miss. Before we begin the ascent, ensure you are subscribed to the Charlie Munger Academy. We are building a community dedicated to the pursuit of rationality and the preservation of capital. Click the subscribe button now. Let us engineer your first million. Part 1. The Critical Mass, Conquering the First $100,000. We begin our descent into the mechanics of wealth accumulation by confronting the single most difficult barrier in the entire lexicon of finance. It is not the accumulation of the first million that breaks the human spirit. It is the accumulation of the first $100,000. Charlie Munger, a man known for his elegant mental models and philosophical depth, abandoned all politeness when describing this specific threshold. He famously declared, "The first $100,000 is a bitch, but you gotta do it." He did not say it was challenging or difficult. He used a profanity that implies malice, resistance, and brutality. This was not a slip of the tongue. It was a precise diagnosis of the mathematical and psychological forces that array themselves against the beginning investor. To understand how to build a $1 million portfolio, we must first dissect the physics of this bitch phase and understand why 90% of the population dies on this hill, never reaching the summit where the air becomes clear and the gravity becomes light. To comprehend the severity of this challenge, we must analyze the concept of critical mass as it applies to capital. In nuclear physics, critical mass is the minimum amount of fissile material needed to maintain a nuclear chain reaction. Below this mass, the reaction fizzles out, the energy dissipates. In finance, the first $100,000 represents this critical mass. Below this number, the force of compound interest is mathematically negligible compared to the force of your labor. Consider the arithmetic of futility that plagues the early saver. If you possess a portfolio of $10,000, a respectable sum for a novice, and you achieve a spectacular, market-beating return of 20% in a single year, you have generated $2,000 of profit. While the percentage is heroic, the absolute utility is trivial. $2,000 does not change your life. It does not cover a month of rent in a major city. It does not buy your freedom. The result of your investment genius is invisible to your standard of living. This is the valley of disappointment. You are subjecting yourself to the volatility of the market and the discipline of saving, yet the feedback loop from the universe is silent. This lack of positive reinforcement is why most investors capitulate. They look at the mountain, they look at their shovel, and they quit. Munger's prescription for crossing this wasteland is not to rely on investment returns, but to rely on brute force accumulation. During the journey to the first $100,000, you are not an investor, you are a laborer. Your savings rate is the only variable that matters. The return on investment, ROI, is a vanity metric at this stage. If you save $10,000 a year, it takes you a decade to reach the threshold. To do it in the easy way, which paradoxically means the hard way, fast you must compress this timeline. Munger advised extreme measures, walking everywhere, not eating anything that wasn't purchased with a coupon. These are not metaphors for thrift. They are instructions for scorched earth capital preservation. Munger understood that every dollar spent on consumption in your 20s and 30s is not merely a dollar lost. It is a platoon of soldiers decimated before they could ever see the battlefield. We must apply the mental model of opportunity cost to the consumption habits of the aspiring accumulator. Munger viewed money not as currency for present-day goods, but as a claim on future options. When the average individual spends $5 on a premium coffee, they view it as a trivial transaction. The Mungerian mind views it as a financial tragedy. At an 8% compound annual growth rate, that $5 represents nearly $100 of lost capital over a 40-year horizon. When you multiply this by the thousands of trivial transactions that constitute modern life, the streaming subscriptions, the leased vehicles, the dining out, you realize that the average person is not broke because of their income. They are broke because they are eating their seed corn. They are consuming their future freedom in $5 increments. To conquer the first $100,000, one must develop an allergy to unnecessary expenditure. You must invert the standard American dream. You must be willing to look poor in order to become rich. You must accept a temporary degradation in your social signaling to secure a permanent elevation in your financial reality. This brings us to the psychology of the moat. Just as a business needs a moat to protect its profits, an individual needs a psychological moat to protect their savings from the siege engines of envy. Munger identified envy as the stupidest of the deadly sins because it's the only one you can't have any fun at. The primary obstacle to saving the first $100,000 is the pressure to keep up with the Joneses. Your peers will be leasing luxury cars, taking debt-fueled vacations, and buying homes they cannot afford. They will appear to be winning. The rational investor must understand that this is a mirage. They are engaging in fake wealth that is visible but backed by liability. The Munger disciple must possess the inner scorecard. You must derive satisfaction not from the admiration of others, but from the quiet, invisible growth of your net worth. You must be willing to be the person who drives the battered sedan and brings a sack lunch to the office, secure in the knowledge that you are building a nuclear reactor of capital, while those around you are burning wood. The transition that occurs at the $100,000 mark is a phase change in the physics of your portfolio. It is the moment where the internal combustion engine of compounding finally catches a spark. At $100,000, a 10% market return generates $10,000. This is a significant sum. It is likely 10 to 15% of your annual salary. Suddenly, your money is working as a second laborer in your household. It is no longer a passive pile of cash. It is an employee that never sleeps, never complains, and never takes a vacation. This is the moment the bitch releases her grip. The psychological burden shifts. You no longer feel like you are pushing the boulder. You feel the boulder beginning to pull you. You see the path to the million, and it no longer looks linear. It looks geometric. But you cannot reach this phase change without first enduring the pressure. We must also address the agency problem of income during this phase. Munger was a proponent of Lollapalooza effects when multiple forces push in the same direction. You cannot save $100,000 on a subsistence wage solely through coupons. You must attack the equation from both sides. You must scorch the earth on expenses, while simultaneously conducting a blitzkrieg on income. Munger himself did not rely on a single salary. In his early years, he was a lawyer, an investor, and a real estate developer. He stacked income streams. For the modern aspirant, this means the side hustle is not optional. It is mandatory. Every additional dollar earned during the accumulation phase has a higher marginal utility than a dollar earned later in life because it has a longer runway to compound. You must view your time as inventory that must be sold to the highest bidder until the critical mass is achieved. Furthermore, the first $100,000 acts as a great filter for character. Munger believed that wealth was largely a function of temperament. The struggle to accumulate this first tranche of capital is the crucible that forges that temperament. It teaches delayed gratification. It teaches the rejection of herd mentality. It teaches the precise valuation of capital. If you were handed $1 million today without having struggled for the first 100,000, you would likely lose it. You would lack the immune system necessary to protect it from the viruses of greed and folly. The struggle is not an obstacle to the wealth. The struggle is the prerequisite for the wealth. It is the training ground where you learn to be a custodian of capital. Munger would argue that the easy way is only easy because the investor has been hardened by the difficulty of the start. Finally, we must recognize the mathematical inevitability that follows this conquest. Once you have the first $100,000, the second $100,000 takes significantly less time. The third takes even less. The time intervals between milestones collapse. This is the velocity of money. By the time you approach the $1 million mark, your portfolio fluctuations in a single day might exceed what you used to save in an entire year during the bitch phase. This is the reward for the suffering, but you must never forget that the entire edifice of the $1 million portfolio rests on the foundation of that first, painful, grinding, unglamorous $100,000. It is the ante you must pay to sit at the table of capitalism. Without it, you are merely a spectator. With it, you are a player. Part 2. The sit on your ass. Strategy, tax efficiency, and patience. We move now to the second pillar of the Munger blueprint, a strategic doctrine that stands in violent opposition to the kinetic energy of the modern financial industry. Having conquered the critical mass of the first $100,000 through the brute force of labor and savings, the aspiring millionaire is now besieged by a new enemy: the seductive illusion of activity. The entire infrastructure of Wall Street, the brokerages, the financial news networks, the algorithmic trading firms, is predicated on the lie that wealth is a function of motion. They sell the narrative that to make more money, you must do more things. You must trade the news, hedge the macro, and rotate the sectors. Charlie Munger, the architect of rational capital allocation, viewed this hyperactivity not as a strategy, but as a pathology. He advocated for a philosophy of extreme lethargy, famously stating, "The big money is not in the buying and the selling, but in the waiting." This is the sit-on-your-ass strategy. It is not an act of laziness. It is an act of sophisticated mathematical aggression against the twin destroyers of capital: frictional costs and taxation. To understand the necessity of this strategy, we must first perform a forensic audit on the mathematics of portfolio turnover. In the physics of finance, friction is the force that opposes the accumulation of wealth. Every time you execute a trade, you are subjecting your capital to friction. There is the bid-ask spread, the commission, even if hidden in the order flow, and the slippage. These are the crumbs that the croupier sweeps off the table before the dice even land. However, the most lethal form of friction is not paid to the broker, it is paid to the sovereign. The tax code of the United States, and indeed most Western economies, is designed to punish the impatient. When you sell an asset held for less than a year, you trigger a short-term capital gains tax event. The government treats your investment profit as ordinary income, taxing it at the highest marginal rate, which can exceed 40 or 50% depending on your jurisdiction. This is a catastrophic interruption of the compounding process. You are effectively severing the arm of your snowball just as it begins to roll. We must conceptualize the unrealized capital gain through the Mungerian lens. Munger did not view an unrealized gain merely as a paper profit. He viewed it as an interest-free loan from the Treasury. Let us analyze the arithmetic. If you buy a stock for $100 and it rises to $200, you have a $100 profit. If you sell, you owe the government perhaps $30, leaving you with $170 to reinvest. However, if you do not sell, if you sit on your ass, that $30 remains in your account. It continues to work for you. It continues to compound. Over a period of 20 or 30 years, the returns generated by that deferred tax liability can equal or exceed the original principal. You are leveraging the government's money to build your own fortune. This is the hidden leverage of the long-term holder. It is a form of leverage that carries no margin call and charges no interest. Munger held stocks like Coca-Cola and the Washington Post for decades, effectively borrowing billions of dollars from the IRS at 0% interest to fuel Berkshire Hathaway's growth. This strategy requires a re-evaluation of the concept of liquidity. The market prizes liquidity, the ability to sell instantly. Munger viewed liquidity as a trap. The ease with which you can sell a stock is the very reason most people fail to hold it. When panic strikes, or when a stock drops 20%, the sell button is right there, glowing on the screen. It is too easy to capitulate. Munger often spoke of the punch card mental model, suggesting that investors should act as if they only have a punch card with 20 slots for their entire lifetime. Every time you buy a stock, you punch a hole. When the 20 holes are gone, you can never make another investment. This constraint forces a level of due diligence and conviction that renders the need to sell obsolete. If you can only make 20 decisions, you do not buy a speculative tech stock for a quick trade. You buy a fortress balance sheet that you intend to marry. The sit-on-your-ass strategy is the practical application of this punch-card philosophy. It imposes an artificial illiquidity on your portfolio, protecting you from your own emotional volatility. We must also confront the psychology of boredom. The human brain is wired for novelty. We seek dopamine hits. The financial markets provide a constant stream of stimuli, flashing numbers, scrolling tickers, breaking news. To sit on your ass while the world is frantic requires a stoic detachment that borders on the superhuman. During the dot-com bubble of the late 1990 seconds, Munger and Buffett were mocked as dinosaurs. They sat on their hands while their neighbors got rich on unprofitable internet stocks. They did nothing. The pressure to act, to participate in the mania, was immense. But Munger understood that the mania was a transfer of wealth from the impatient to the patient. He knew that activity without value is simply noise. When the bubble burst, the frenetic traders were wiped out, and the lethargic holders of quality assets remained standing. The ability to endure boredom is a competitive advantage. In a world where the average holding period for a stock has dropped from years to months, the investor who holds for decades is playing a different game entirely. They are playing time arbitrage. Furthermore, the sit-on-your-ass strategy acts as a filter for quality. You cannot sit on your ass if you are sitting on a pile of dynamite. If you own a portfolio of speculative, low-quality companies, you must watch them like a hawk. You must trade them because they might go to zero. Therefore, the commitment to lethargy forces you to upgrade the quality of your assets. You can only afford to do nothing if the businesses you own are doing the work for you. This aligns perfectly with Munger's preference for the inevitables businesses with wide economic moats and pricing power. If you own a company like Costco or Apple, you do not need to check the stock price every day. You know the business is sound. You know the management is competent. The stillness of the investor is a reflection of the robustness of the asset. You are outsourcing the labor of wealth creation to the CEOs of the world's greatest companies, allowing you to reclaim your time for the pursuit of wisdom. We must analyze the fourth dimension of investing: time. The relationship between risk and time is inverse. Over one day, the stock market is a casino. The probability of loss is nearly 50%. Over 1 year, it is a voting machine. Over 20 years, it is a weighing machine. As the holding period extends toward infinity, the standard deviation of returns creates a cone of certainty around the intrinsic growth of the underlying economy. By engaging in the sit-on-your-ass strategy, you are pushing your portfolio into the zone of statistical safety. You are allowing the rule of 72 to function without interruption. If your capital doubles every 7 years at a 10% return, interruptions are costly. A single interruption, a panic sale, a tax bill, a pivot to a new strategy resets the geometric progression. Munger teaches us that the first rule of compounding is to never interrupt it unnecessarily. The vast majority of interruptions are self-inflicted wounds caused by the inability to sit still. Crucially, this strategy is the ultimate antidote to managerial risk. Most mutual funds and hedge funds underperform the market net of fees because they are too active. They are trying to justify their fees by looking busy. They churn their portfolios, incurring taxes and transaction costs that drag down returns. By managing your own million-dollar portfolio with a strategy of doing nothing, you are eliminating the agency costs of Wall Street. You are paying zero management fees, or near zero for index funds, and zero performance fees. You are keeping 100% of the economic rent generated by your capital. In a low-return environment, the difference between a gross return and a net return is the difference between wealth and stagnation. Munger's lethargy was the ultimate form of cost control. In summation, the sit-on-your-ass strategy is not a passive resignation. It is an active, militant defense of your capital against the parasitic forces of the financial industry and the tax code. It is the recognition that, in the realm of investing, motion is not progress. Progress is the silent, uninterrupted compounding of high-quality assets over long periods of time. It requires you to be a historian, understanding the long arc of economic growth. It requires you to be a stoic, indifferent to the hysteria of the crowd. And it requires you to be a mathematician, respecting the devastating power of the negative exponent that is taxation. By mastering the art of doing nothing, you allow the easy way to manifest. You stop rowing the boat against the current and simply raise the sail, letting the winds of capitalism carry you to the million-dollar destination. Part 3. The Architecture of Quality Cannibals and Moats. We have established the foundational discipline of accumulating critical mass and the strategic lethargy required to let time do its heavy work. However, the passive accumulation of capital and the refusal to interrupt compounding are insufficient if the underlying vehicle of that compounding is defective. To build a million-dollar portfolio with the ease and inevitability that Charlie Munger advocated, we must transition from the behavior of the investor to the architecture of the asset itself. We must reject the modern portfolio theory of diversification, the holding of hundreds of mediocre businesses to hedge against ignorance, and embrace the philosophy of extreme concentration in quality. Munger did not become a billionaire by buying the haystack. He became a billionaire by identifying the few, inevitable businesses that defied the laws of economic gravity. This pillar of the strategy is focused on the architecture of quality, specifically identifying two rare corporate species that do the heavy lifting for you: the economic moat and the cannibal. To understand the necessity of the moat, we must first confront the brutal thermodynamics of capitalism. In a free market, capital is like water. It seeks the path of least resistance. If a specific industry is generating abnormally high returns on invested capital, it acts as a beacon, attracting competitors. These competitors enter the market, undercut prices, and bid up the cost of labor and raw materials. Over time, this competitive erosion drives the returns of the business down to the average cost of capital. This is the phenomenon of mean reversion, and it is the force that destroys the long-term wealth of the average stock picker. Munger's genius was in identifying the anomalies, the businesses that possessed a structural defense mechanism so powerful that it repelled this invasion of competition. He called this defense the economic moat. The moat is not merely a brand name or a good product. It is a structural advantage that renders competition mathematically futile. We must look for the unregulated toll bridge. Munger often cited the example of a newspaper in a one-newspaper town in the pre-internet era, or a bridge connecting two cities. If you own the only bridge, you possess pricing power. You can raise the tolls every year to match or exceed inflation, and the commuters will still pay because the alternative swimming across the river is impossible. In the modern era, this toll bridge takes the form of switching costs and network effects. Consider the ecosystem of Apple. Once a user is locked into the hardware, software, and services, the pain of leaving is immense. Apple can raise the price of the iPhone or the iCloud subscription with impunity. This inelasticity of demand is the hallmark of the moat. For the aspiring millionaire, owning a business with a moat means owning an asset that fights inflation on your behalf. While the purchasing power of your cash erodes, the moat raises its prices, preserving the real value of your capital. We must then analyze the specific metric of pricing power, which Munger and Warren Buffett identified as the single most important decision in evaluating a business. If a company has to have a prayer session before raising the price by 10%, it is a terrible business. If it can raise prices without losing market share, it is a wonderful business. See's Candies, the acquisition that transformed Munger's philosophy, is the archetype. See's sold boxed chocolates, a commodity in theory. But in practice, they sold share of mind and emotional validation. A man buying chocolates for his wife on Valentine's Day is price insensitive. He cannot buy the cheaper competitor without signaling a lack of affection. This psychological monopoly allowed See's to raise prices every December 26th for decades. The capital required to generate these higher earnings was zero. This is the magic of the moat. It generates more cash without requiring more investment. The second pillar of this architecture is the cannibal. While the moat protects the business from the outside, the cannibal optimizes the business from the inside. Munger had a profound appreciation for companies that aggressively repurchase their own shares. In the lexicon of finance, this is known as a share buyback, but Munger viewed it as a form of corporate autophagy that mathematically guarantees the enrichment of the remaining shareholders. When a company like AutoZone or O'Reilly Automotive generates massive free cash flow, it has two choices: pay a dividend or buy back stock. Dividends are tax inefficient. They are taxed the moment they hit your account, interrupting the compounding process. Buybacks are tax-deferred. When a company retires its own shares, the denominator of the earnings per share equation shrinks. Let us deconstruct the arithmetic of the cannibal. Imagine a company with 1,000 shares outstanding, earning $1,000. The earnings per share is $1. If the company uses its cash to buy back and retire 500 shares, there are now only 500 shares remaining. Even if the total earnings of the company remain flat at $1,000, the earnings per share doubles to $2. The stock price, tracking the earnings per share, will double. You, the passive holder, have doubled your money without the company growing its top line by a single cent. You have increased your percentage ownership of the enterprise without spending a penny of your own capital. This is the silent partnership. Munger loved cannibals because they turn the volatility of the market into an advantage. When the stock market crashes, the cannibal can buy back its own stock at a discount, accelerating the destruction of the share count. This provides a floor under the stock price and creates a mechanism where the business gets stronger because the market is weak. The synthesis of these two forces, the moat and the cannibal, creates a Lollapalooza effect of value creation. When you own a business that is protected from competition moat and is constantly increasing your stake in it, cannibal, you are harnessing the most powerful forces in capitalism. This allows for the sit-on-your-ass strategy to work. You do not need to trade. You do not need to time the market. You simply need to hold the asset while the management team raises prices and retires shares. This architecture is what allowed Berkshire Hathaway to compound at 20% for 50 years. It was not a diversified portfolio of 500 mediocre stocks. It was a concentrated portfolio of toll bridges and cannibals. However, we must also address the filtration process required to find these assets. This involves the inversion of the selection process, the creation of the too hard pile. Munger famously tossed 99% of investment opportunities into the too hard pile. He did not attempt to value complex pharmaceutical pipelines, speculative mining operations, or indecipherable banking derivatives. He understood that complexity is a form of fragility. To build the million-dollar portfolio the easy way, you must ruthlessly eliminate any business that requires a PhD to understand. The moat should be obvious. The cannibalism should be visible in the financial statements. If you have to use a complex spreadsheet to justify the investment, it is not an inevitable, it is a speculation. We must scrutinize the return on invested capital, ROIC, as the true north of this architecture. Munger argued that over the long term, it is hard for a stock to earn a much better return than the business which underlies it earns. If a business earns 6% on capital over 40 years, you are likely to make 6% even if you bought it cheap. If a business earns 18% on capital over 20 years, you will end up with a hell of a result, even if you paid an expensive-looking price. The architecture of quality demands that you focus almost exclusively on high ROIC businesses. These are the companies that can reinvest their profits back into themselves to grow, or use that capital to buy back stock. They are the compounding machines. The cheap stock with low ROIC is a trap. It is a cigar butt that requires constant trading. The expensive stock with high ROIC is a fortress that requires only patience. Furthermore, we must consider the management alignment. Munger looked for managers who thought like owners, not employees. He detested the imperial CEO who diluted shareholders with excessive stock options while making vanity acquisitions. He sought the capital allocators, CEOs like Henry Singleton of Teledyne, who treated the company's share count as a precious resource to be conserved and reduced. In the architecture of your portfolio, you are delegating the decision-making to these CEOs. You are entrusting them with your critical mass. Therefore, you must demand that they treat your capital with the same reverence that you do. The combination of a high-quality business and a high-integrity management team is the holy grail of the Munger philosophy. In summation, the architecture of quality is the rejection of the idea that all stocks are created equal. It is the understanding that the stock market is a warehouse filled with mostly junk and a few rare diamonds. To reach your first $1 million easily, you must ignore the junk. You must ignore the hype cycles, the IPOs, and the next big thing. You must focus your limited capital into the few businesses that possess the physics of inevitability. You want the toll bridge that cannot be bypassed. You want the machine that eats itself to make you richer. By populating your portfolio with these assets, you remove the anxiety of the daily price fluctuation. You know that the underlying economics are working for you, day and night. regardless of what the Federal Reserve does or who is in the White House. You are no longer a speculator betting on price. You are an owner participating in value. Part 4. The Inversion of Ruin. Risk Management. We arrive now at the final and most absolute pillar of the Munger doctrine. We have constructed the critical mass of capital through the crucible of the first $100,000. We have mastered the tax-efficient lethargy of doing nothing, and we have populated the portfolio with the invincible architecture of moats and cannibals. Yet, a man can possess all of these things, the discipline, the patience, and the asset selection, and still arrive at the grave destitute. History is littered with the corpses of high IQ geniuses who built empires only to watch them vaporize in a single moment of madness. To secure your first $1 million, and more importantly, to keep it, you must master the art of the inversion of ruin. Charlie Munger did not view risk through the academic lens of beta or volatility. He viewed risk as the binary probability of permanent loss. His entire philosophy was built on the algebra of survival. He understood that in the multiplication game of compounding, the number 0 is the ultimate destroyer. Any number, no matter how large, multiplied by 0, becomes 0. Therefore, the rational investor does not obsess over maximizing the upside. They obsess over eliminating the 0. They invert the problem. Instead of asking, "How do I get rich?" Munger asked, "Where am I going to die?" And then he simply never went there. This final phase of our blueprint is a forensic analysis of the landmines that wait to destroy the aspiring millionaire and the specific engineering required to defuse them. To understand the mechanics of ruin, we must first confront the single most dangerous financial instrument ever invented: leverage. In the lexicon of Munger, there are 3 things that ruin a smart person: liquor, ladies, and leverage. While the first 2 are personal vices, the third is a mathematical guillotine. Borrowing money to buy assets is the siren song of the impatient. It offers the seductive promise of accelerated returns, of reaching the $1 million goal in half the time. But this acceleration comes at the cost of path dependency. Let us deconstruct this concept. If you invest in the S&P 500 with cash, your outcome is path independent. The market can drop 50%, stay down for 5 years, and then recover to new highs. Because you have no debt, you are not forced to sell. You can endure the volatility. You survive the valley to reach the peak. However, if you invest with 50% margin borrowed money, your outcome becomes strictly path dependent. If the market takes a specific path, a sharp drop before it recovers, you receive a margin call. You are liquidated by your broker. You are forced to sell your assets at the absolute bottom to repay the loan. The market may subsequently recover and triple in value, but you will not participate. You have been washed out of the game. Munger famously pointed to the tragedy of Rick Guerin, the third member of the original Buffett-Munger triumvirate. Guerin was just as smart as Buffett and Munger, but he was in a hurry. He used leverage. In the brutal bear market of 1973 and 1974, he faced margin calls and was forced to sell his Berkshire Hathaway shares to Warren Buffett at bargain prices. Guerin was wiped out not because he picked bad stocks, but because he engineered a fragile balance sheet. To build your first million the easy way, you must reject leverage entirely. You must accept that a slower, unbreakable path is infinitely superior to a fast, fragile one. We must then analyze the asymmetry of loss. The human brain is poorly calibrated to understand the geometry of drawdowns. We instinctively feel that if we lose 50%, we need to make 50% to get back to even. This is a lethal error. The math dictates that a 50% loss requires a 100% gain just to recover the principal. A 90% loss requires a 900% gain. This asymmetry means that defense is mathematically more important than offense. Avoiding a large loss is more valuable than capturing a large gain. Munger's strategy of inversion of ruin dictates that you must curate your portfolio to avoid the catastrophic tail risk. This involves a ruthless filtration process. You do not invest in companies with bad balance sheets, no matter how exciting the growth story. You do not invest in opaque derivatives. You do not invest in countries with unstable property rights. By removing the potential for catastrophe, you are left with a portfolio that may be boring, but is biologically incapable of dying. The first million is built not on the home runs that you hit, but on the strikeouts that you avoid. This brings us to the psychological dimension of risk, the circle of competence. Munger argued that most ruin comes from intelligent people trying to act intelligent in areas where they are actually ignorant. He divided the world into two zones: the circle of competence, what you know, and the rest of the universe, what you don't know. The size of the circle is not important. Knowing its boundaries is vital. When an investor steps outside their circle, when a dentist tries to day trade crypto, or a software engineer tries to speculate on mineral rights, they are no longer investing, they are gambling with a negative edge. They have become the patsy at the poker table. To avoid ruin, you must have the humility to say, "I don't know." You must have a too hard pile. If an investment requires a complex spreadsheet to justify, or relies on a macroeconomic prediction you are unqualified to make, it goes in the too hard pile. Munger tossed 99% of opportunities into this pile. He waited for the fat pitch, the opportunity that was so obvious, so within his competence, that it required no brilliance to execute. By strictly adhering to your circle of competence, you eliminate unforced errors. You protect your capital from your own ego. We must also confront the FOMO, fear of missing out mechanism, which Munger identified as a primary driver of financial suicide. In every cycle, there will be a mania. In 24, it might be the Nifty 50, the dot-com bubble, the housing bubble, or the crypto craze. During these manias, your neighbors will get rich. People with half your IQ will make millions overnight on speculative garbage. This will trigger a primal, visceral envy. You will feel like a fool for holding your boring index funds and quality compounders. This is the moment of maximum danger. This is when the investor capitulates, abandons their strategy, and chases the bubble just before it bursts. Munger's defense against this was a stoic indifference to the madness of crowds. He quoted Kipling, advising investors to keep your head when all about you are losing theirs. He understood that trees do not grow to the sky. He knew that every bubble eventually bursts, reverting to the mean. By inverting the emotion, by feeling fear when others feel greed, you insulate yourself from the blast radius of the collapse. You stay safe in your fortress while the speculators are incinerated. Critically, the inversion of ruin extends to the custody of your wealth. Munger was paranoid about counterparty risk. He did not leave his assets in places where they could be seized, frozen, or stolen. In the modern era, this means avoiding obscure crypto exchanges, unproven fintech platforms, or unregulated investment schemes. It means holding your assets in major, insured, reputable custodians. It means understanding that if you do not hold the keys, or if the government does not insure the deposit, you are taking a risk that pays no premium. The boring, standard infrastructure of the financial world is your friend. You are not trying to be a pioneer in how you store your money. You want to be a settler. Pioneers get arrows in their backs. Settlers get the land. We must also discuss the role of cash as a risk management tool. While we previously discussed cash as a drag on compounding, Munger also viewed it as a strategic weapon for survival. He always kept a fortress balance sheet with billions in cash equivalents. For the individual building their first million, this translates to an emergency fund of 6 to 12 months of living expenses. This is not investment capital, it is insurance. It protects your compounding machine from the friction of life. If you lose your job, or your car breaks down, or a medical emergency strikes, you do not want to be forced to sell your stocks to pay the bill. If you are forced to sell stocks during a market downturn to fund your life, you are crystallizing a permanent loss. You are interrupting the compound interest. The cash buffer stands between your life and your portfolio. It allows you to sleep at night. It allows you to ignore the volatility of the market because your immediate needs are secured. Munger viewed this liquidity as the price of admission for a rational life. Finally, the inversion of ruin requires a confrontation with the great filter of character. Munger believed that character is destiny. A person with a flawed character, someone who is impulsive, dishonest, or prone to shortcuts, will eventually find a way to destroy their own wealth, no matter how much they accumulate. The markets are an efficient mechanism for transferring money from the impatient to the patient, and from the emotional to the stoic. To build $1 million and keep it, you must cultivate the virtues of the gentleman. You must be reliable. You must be honest. You must be rational. You must uphold your fiduciary duty to your future self. The ultimate risk is not the market. The ultimate risk is the face looking back at you in the mirror. By mastering yourself, you master the risk. In summation, the inversion of ruin is the final lock on the vault. It is the understanding that the first rule of compounding is to never interrupt it unnecessarily, And the second rule is to never forget the first rule. It is the rejection of leverage, the embrace of competence, the resistance to mania, and the cultivation of stoicism. By focusing on what could kill you and avoiding it, you leave only one path open, the path of survival. And in the game of compounding, survival is the only prerequisite for victory. If you can stay in the game long enough, if you can avoid the zero, the mathematics of the universe will ensure your arrival at the million-dollar destination. We have traversed the landscape of the first million. We have conquered the critical mass. We have mastered the sit-on-your-ass strategy. We have built the architecture of quality. And we have sealed the fortress with the inversion of ruin. The blueprint is complete. The variables are defined. The path is cleared of obstacles. All that remains is the will to walk it. Charlie Munger has passed the torch. It is now your duty to carry it. To continue this education, to refine your mental models, and to stand shoulder to shoulder with a community of rational investors, you must take the final step. Click the subscribe button for Charlie Munger Academy right now. Do not let this wisdom fade. Build your fortress. Subscribe, invert, and prosper.